We are gradually coming to the end of the training. By tomorrow, we'll be rounding up the training. So I believe we have learned um, some things so far. We have learned a lot so far. And yesterday, I posted a um, a link on VAT filing and CIT filing on the group. I believe we have gone through the video. Well, if you are yet to go through the video, you can still go ahead and watch it. And by tomorrow, we'll be discussing on that. So, our last class, we finished our preparation of financial statements, and today we are going to be looking at how to um, incorporate journals in our financial statements. So that's what we are going to be looking at today, how to incorporate journals in our financial statements. So if you were not in the previous classes, you can check our YouTube channel. We'll post the classes of the trainings of previous days. You can watch so that you understand where we are and you are not lost. So let's just go to let me share my slide, my Microsoft Excel now so we can start. Okay, so I believe you can. All right, so um okay, I'm supposed to share. There's a journal I'm supposed to share, but let me just move the sheet to the document I'm sharing now. Just a moment, please. So I believe so there's a sheet called journal that is currently showing on my screen. So they are different. Okay, so there's something I would like to explain before we come to this point. So let me go back to my slide. Okay, so there's something I need to, like I said, I need to explain before we go back to that main document now. And that is journals. What does journal entry is mean? So A journal entry, as we have been taught or we have been taught in school, is the formal recording of a business transaction in an accounting record using the double entry system. So every journal must have a date, it must have an account that you want to debit, the account or accounts that you want to credit, the amount, and a narration. There must be a narration. There must be a narration. There must be a narration. So, so why are journals raised? Journals are raised to correct accounting errors, to record adjustments, to recognize expenses and revenue previously omitted, to adjust overstatements and understatements. So these are the various reasons why we raise journals in our financial statements or in our records. So how to raise a journal entry? Please take notes. First of all, you need to identify the transaction. You need to identify the transactions, the transaction, determine the affected account. So you want, after identifying the transaction, so a transaction can be a sales that was made that was omitted in your financial record, or an expense that was made that was omitted. So that's a transaction. Maybe payment of rent, that's a transaction. um Purchase of goods, that's a transaction. So when you identify the transaction, you determine the affected accounts. What are the accounts that are affected in that transaction? Next, you want to apply the debit and credit rules. Determine which account should be debited and which should be credited, right? Which account should be debited and which should be credited. The next is you want to record the journal by entering the transaction details. And lastly, you have to put a narration. So after, for every journal, you must, it's necessary that you put in a narration to explain the purpose of that journal that you are passing or that transaction. So what journals are raised for? Organization raise journals for several accounting adjustments. We have common journals categories can be include the Accura's journal. So we know what Accura means. When you have used a benefit for something but you have not made payment for it, that is an Accura transaction. So let's assume your rent is due, your company rent is due for payment, but you have not made payment for it, but you have already started enjoying the benefits. Maybe your rent is due for payment since May, or let's say April, but we are still in June, you haven't made payment for it. So there's 2 months accrued rent that you need to recognize in your book. So you have used that the benefit, you have used the apartment, but you haven't made payment for it. So that's accruals. They are different. There's accrued insurance premium, accrued yes, majorly those are anything that you pay monthly. That's where you actually find um the accrual or prepayment coming in. Then prepayment is when you pay ahead, payment in advance. Yes, payment in advance. Accrual is just um in arrears. So the next one is depreciation journals. You want to pass in your depreciation. We have provision journals, we have corrections journals. When you have an error in your books and you want to correct it, you correct that through a journal. Reclassification journal, probably you wrongly classify an expense, you want to reclassify it, you do that through a journal. We have payroll journals, inventory adjustment journals. So these are what journals are raised for. So now that we know this, we can now go to our practical session, which will be illustrating in Microsoft Excel. So now um, I'm going to share the Excel, my Microsoft Excel now, so we can begin. So I believe we got that. Do we have any question regarding that?
No,
All right.
not at
So let's continue then. So now we have some assumption here. We assume that um, there's a prepayment that we need to put in our account. So this is the financial statement that we made the last class. We prepared the three major statements in the financial statement: the statement of profit or loss, the statement of financial position, and the statement of cash flow. So now we discover that there are some transactions that we have not incorporated in our financials. So we are going to be doing that through journal entry. So we have prepayment, we have depreciation, we have petty expenses, we have trade receivables, we have trade payables. So starting with the first one, trade prepayment. So let me call this journal details. Why this will be the journal itself. So the first one we have there is prepayment. So we had, if you look at the note to our account, we had rent before. We have rent of 250,000, right? That we saw that was paid um from our bank statement. But the question you want to ask is, what period does this rent cover? Rent usually is within a year, right? Majority is within a year. So you want to know from what point to what point does this rent cover? And remember your matching concept. You have to recognize expenses that are within the period that you are preparing financial statement for. So if let's say you are preparing financial statement for 2024 and your rent expanded to 2025, you cannot recognize the whole of that rent in 2024. So you have to make adjustment for accruals or prepayments, right? So that's what this whole thing is talking about. So you have to, it's only the aspect that applies to that period that you are working with or you are working on. That's what you recognize in your financial statement. So for this rent, it was given to us that we are preparing the 2024 financial statement. So it was given to us that the rent was paid in May and it covers the period from June 2024 to July 2025, which means that we are not going to recognize the whole of the 250,000 in our rent. We are going to recognize some as rent and some as prepaid rent because the rent actually elapsed to 2025, right? So what we are going to be doing here is to calculate how many months is applicable to 2024 and how many months is applicable to 2025. So the first thing is we want to get the monthly rate for this rent. So which is the total amount 250,000 divided by 12, right? So this is the monthly rate for the rent. So we want to know how many months is applicable to 2024. So we have from June to December is we have June, July, August, September, October, November, December, which is 7 months. So 7 months is applicable to the month of the year 2024, while 5 months is applicable to the year 2025. So in 2024, so let me put year 2024 and year 2025. So in year 2024, what we just do is to multiply the monthly rate of the rent times the number of months, which is this. And in 2025, we have 5 months. The monthly rent divided multiplied by the number of months. So at the end of the day, when you add the two together, it should give you it should give you 250,000. So if it's giving you something else, then your calculation is wrong. So it must give you 250,000. So the next thing you want to do is, okay, which part am I going to recognize as my rent for the year, and which part is going to go into accruals or prepayment? So we don't have accruals here. What we have is prepaid rent because it's paying ahead. So the part that will be recognized as rent is 145,000. So 145,000 will be recognized as rent, while 104,000 will be recognized as prepaid rent. But already, remember, we have included this rent in our financials. So we cannot go and be passing two journals again. So what we just do is to reduce the rent that we have included in our financials by 104, so it can bring it to 145,000. So that's what we are going to do. Then this 104, we are going to recognize it as prepaid rent. So what are we going to do now that we have, this is a transaction that we have identified. Remember, you have to identify the transaction first, then you determine the accounts that are involved. So the transaction is prepaid rent. You want to recognize prepaid rent, right? So what are the accounts involved? The accounts involves rent and prepaid prepayment. That you call it prepayment or prepaid rent. So rent and prepayment. So the next question we want to ask is, which of these accounts, which one is increasing and which one is decreasing? Which one is increasing and which one is decreasing? So remember, I said we have recognized rent of 250,000. Rent account is there. Now we want to reduce that rent by 104, right? And rent is an expense, is an expense account. So since it's an expense account has a debit balance. If we are to reduce it, we need to what? Credit it, right? We need to credit it. Then prepayment, we want to increase prepayment, and prepayment is a current asset and it has a debit balance. So to increase it, we will debit it. I believe we got that. So we are going to debit prepayment and credit rent with 104,000 and debit rent. So these are journal that we are going to be passing. So let's go to the journals and do the workings there. So please, if you have any question, just note it down. At the end of the session, we'll take questions. So now, okay, let me create a column for numbering here. So this is our first journal. We have rent. So I normally like bringing the debit before the credit. So since we are debiting prepayment, I'll bring it first. Prepayment, then rent account. So remember, we are using that 104. This 104, we want to reduce rent and recognize prepayment of 104. So then we'll credit. You can just pick the figure because, mind you, your total debit must be equal to your total credit. So both figure must be the same if it's just two accounts that are involved. If it's more than two accounts, then the figures doesn't necessarily need to be the same. So after doing this, you need to put in narration. It is very important that you put in a narration. So we'll put a narration that being entries to recognize prepaid rent. So with this, we are good to go. So the next thing we want to do is to incorporate this in our financial, in our accounts, in our account. So to do this, once you've brought in your journal like this, the next thing you want to do is to go to your extended trial balance. And first of all, the first journal there account is prepayment, and in our extended trial balance we don't have anything like prepayment here, right? So we'll create a column for prepayment, and like I said, prepayment is a current asset, so I'm going to put it under the class of current assets, prepayment. So the next thing is I want to go under my journal column, under the journal column, not opening balance, not trial and transaction for the year, but under the journal column, and go to, since we are debiting prepayment, I'm going to post that figure under debit side. So I'm going to link it from my journal. So equal to, I'll go to my journal sheet and pick the figure and press enter. So I will do the same thing for rent. I'll do the same thing for rent. I already had rent in my extended TB, and this time around I want to credit it under journal. So I would put it under credit side and pick the figure as well. So when you do this, it is very important that your journal are the same. The total credit must be equal to the total debit. Now we have a problem here. Our extended TB is supposed to be the same as well, but it's showing that there is a difference, and that's because we have not brought in the, okay, that's because the prepayment here is showing on the credit side, which is not supposed to be. It's also supposed to be appearing only on the debit side. So I'm going to delete the one appearing on the credit side. With this, our extended TV will agree, right? So the next thing is, remember the difference in our, so when you are doing all of this adjustment, be checking all of your um total. Are they accurate? The ones that are supposed to agree, are they the same? And the ones that are, if there's a difference, they must be the same. Are they agreeing, or are they the same? So now if you look at our SOPL, remember I said in our last class when we were doing this, the difference between the two must be the same number. So but if you check now, there's the numbers are different, and that's because one an item is not appearing in one of the statements, and that's coming from the statement of financial position. So the prepayment, remember we just introduce it, so it's not yet appearing on the statement of financial position. So I need to drag down this formula so that it will appear here on the debit side. So with this, our accounts will be the same. So whenever you are passing any journal, you have to take notes, go through your work, and ensure everything is in order. So the next journal we are going to be passing is, so with this, we have done the adjustment in our extended TB. The next thing we want to do is to adjust it on our notes to the account, So we are not going to be touching rent. You can see rent has adjusted itself to 145, from 250,000 to 145. So we are not adjusting rent. The item we are adjusting is our current asset. So we don't have current assets here before. Um okay, so I'm going to title this prepayment and call it prepaid rent. So I'm going to pick that figure from the extended TB, 104. Then okay, So this is it. The next thing I want to bring into my financial statement of financial position. So I'll put in here under current asset now prepayment and pick the figure from the notes to my account. So with this, I noticed that it's only showing the first figure, so I have to sum it up again. So with this, my financial statement of financial position has agreed 1 million. It was formerly 900 and something, but because we made a journal, everything will adjust itself. The only ones you are going to adjust is the account that was not there before, which is the prepayment. Rent is going to adjust itself. So that's it. So now the next journal that we have to pass now is depreciation. So we had purchase of two different assets. We had the purchase of two different assets, which is office equipment and furnitures and fittings, right? Office equipment, furnitures and fitting. So now we are the assumption is that the assets are depreciated on 20% straight line method, which means the asset has 5 years, 5 useful life. The useful life of the asset is 5 years. Okay. So what we are going to do is to take 20% of the cost. So we'll go to the note to the account. All right, so let's do it here. We'll get the figure for furniture 150,000, office equipment 350,000. So office equipment is 350,000, furniture is 150,000. So since it's on a straight line method, we just do 20% this times this. So these are depreciation. We'll do the same for this. So the next thing we want to do is to recognize this figure in our financials. So these are depreciation for each of them. So to now this is the transaction depreciation. Now, what are the accounts involved? The next question you want to ask is what are the accounts involved? For the recognizing depreciation, the accounts involved is depreciation accounts and accumulated depreciation for each of the assets affected. So we want to debit depreciation for office equipment, we want to debit depreciation and credit accumulated depreciation office equipment. For furniture and fittings, we want to debit depreciation and credit accumulated depreciation furniture and fittings. So that is the um double entry we are doing. So depreciation is an expense, accumulated depreciation is more like a liability that we are going to use to reduce the cost to get our net book value. So we'll go to our journal sheets and do the adjustment. So we have depreciation, then we are going to be having accumulated depreciation, F and F. So furniture and fittings. So I'm going to add these two. For the office equipment, I'll call it O and E. So now is I'm going to pick those figure from the calculation we did. So I will add up the two depreciation. I will add up the two depreciation F8 and F9. Then I'll bring them individually under accumulated depreciation because they are two different assets. But remember, depreciation, the reason why I had them up, we are not going to be creating depreciation for each of the assets. We'll merge them together. But for the accumulated depreciation, because of our notes, the notes of our PPE, we are going to um separate them. So that's why I'm separating accumulated depreciation. Or for depreciation, I can merge them together. So at the end of the days, so your journal is not compulsory that it's two accounts. Your journal can be more than 10 different accounts involved. But at the end of the day, your total credit must be equal to your total debit. So we have 100,000 here as our debit, and our credit we have 100,000. So we have being we have to put an narration, being entries to recognize depreciation. Being entry to recognize depreciation, right? So we'll go to our extended TB to recognize this as well. So under their operating expenses, we don't have depreciation there before. Depreciation is an administrative expense. So we are going to put it under operative expenses. Then accumulated depreciation will be under non-current liability. So the next thing I want to bring in the figures. So first of all, my depreciation is on the debit side under the journal. Remember, we are posting them under the journal. Then the next is my accumulated depreciation on the credit side. So the next thing you want to do is to check, are they all in order? So this one is on the credit side. Each under my extended TB it should not be on the debit side, because on the debit side it's showing as negative. So I'm going to delete those ones appearing in negative. So I'll go to my depreciation as well. Is it appearing well? Depreciation is not appearing well too. So I need to drag it to ensure it's on the debit side. Then my journal is not accurate. It's telling me that there's a difference, which means there's something that is not um adding up. Something is not adding up. Okay, so my summation did not pick this, so I need to drag it so it can pick it. Then so with this, it's the same thing now. So I think the same thing is happening here. My summation did not pick this, so I need to drag it. So okay, this is not appearing here, and my summation did not pick it as well. So you have sometimes it may be as a result of. So for this one, my accumulated depreciation is not appearing on my statement of financial position. So these are things that you check for when you are bringing in a new item that is not in the extended TB. Ensure that it is appearing where it's supposed to be. For if it's a statement of profit or loss item, check, is it appearing there? If it's a statement of financial position item, is it appearing there? So that's the only way your financial can actually agree. So the next thing we want to do is to incorporate it in the financial statement. So I'll go to the note to the account. For the depreciation, I will come under operating expenses, I'm bringing my depreciation. Remember, it was not there before, so I need to bring it in. So I'll go to extended TB and bring it in and check, does your summation picks it? If it does it, drag and ensure it picks it. So with this, my statement of profit or loss should agree with what I have. My loss should agree with what I have in my extended TB. So it's correct now. Then the next thing I want to do, bring in my accumulated depreciation. So those figures will come under depreciation charge for the year. So I'll pick them from my extended TB. This is furniture and fittings. Okay. Why this is operating expenses. So at the end of the day, I should have a total. So this is my net book value. My net book value has been reduced. So it will automatically um appear on my statement of financial position, and everything will recompute itself. So that's it. So the next journal entry, I think we still have a few minutes more. Um, Petty cash expenses. So there were some interest. We have interest in our financials. Petty cash, which is not supposed to be. We are not supposed to have petty cash. You need to split the account, show the expenses of that petty cash. So I need to cancel out this petty cash and bring in the expenses that was actually used, that was incurred. So I'm going to bring in, so these are the expenses that were incurred that made up that 150,000. So I'm going to bring in these expenses and take out petty cash. So to do that, I'm still going to use a journal, which I'll call journal 3. So what I'll just do is to copy all of these expenses. So since they are expenses, they will be debited with the various amounts. So I'm going to pick the amount from here. So I can just click and drag this down. So now I've gotten all the expenses. So the next thing is, which account am I reducing? Petty cash is also an expense account, and now it's also an expense account. So since I'm going to reduce it, I'm going to be what? Crediting it. So I'm crediting it with the sum of everything here. With this, my total credit is equal to my total debit is equal to my total credit. So I'll put my narration, be entries to recognize petty expenses. So next thing I want to do is to go to my extended TB and bring in all of these expenses. So the first expense there is telephone expenses. So telephone expenses will be debited. So when I'm debiting telephone expenses, that means I'm adding to it. The next is staff welfare. Next is printing and stationaries. The next is fuel. Okay, we don't have fuel before. We don't have fuel expenses. So I'm going to create an account and bring in the figure. Next is repair and maintenance. Then we have motor expenses. Motor expenses. So the next thing we want to do is to credit petty cash expenses, which we are going. Why are we crediting it? We want to take out that figure because there's nothing like petty cash is not an expense. So the next thing I want to do is to check, is everything appearing where it's supposed to appear? Is there anyone that is not showing where it's supposed to be? So I think this is not summing up as well. There's one that is not adding up. So the next thing, so all of these are not showing here. So I need to drag it down so it will, and also check my calculation, my summation. So with this, so the next thing I want to do is to go to the notes to the financial statement and see if all of this is appearing. So you can see our petty cash is now showing zero, which is our goal. That was our goal, to reduce, to bring the petty cash to zero. So remember we introduced some new items like fuel and motor expenses. So I need to bring it in here. So the fuel and motor expenses. So those are the two items I'm going to bring in. Every others that we made adjustments on, they will automatically calculate it themselves. So you don't need to bother yourself. It's only the items that you just brought in, account that were not there, that you just included. Those are the ones you need to work on. So with this, my my loss should agree with what is in the extended TBA. So you can see. So that's how to pass a journal for your petty cash expenses. So normally, if you are working in a small organization that does, they keep petty cash record and they also do some as run incur expenses spend through their bank statement, you are expected to analyze their petty cash expenses just the same way you analyze the bank statement and bring in those expenses in your financial statement as well, through the use of journal, just the way I did these ones now. So the next one we have is trade receivables and trade payables. Trade receivables and trade payables. So we have just few minutes left. Let's see how we can run with this. So I'm just going to do both at the same time to save time. So we have trade receivable. So those are trade receivable are debtors, right? The next thing you want to ask yourself is, what are the two accounts involved in this kind of transaction? These are people that are owing you. So, and that means they purchase from you and they are owing you. So the two accounts involved is trade receivable itself and sales. Trade receivables and sales. So which one are we increasing and which one are we decreasing? So in this case, both accounts are receiving. They are both going to increase. Trade receivable, it's going to increase, having a debit balance, and sales is also receiving this amount because these people purchase from you but they have not paid. So it's going to increase your sales. So trade receivable is increasing and because it's an asset to the company, it will be debited. And sales is increasing and it has a credit balance, it will be what's credited. So we are going to debit trade receivables and credit sales. So that's what we are going to do here. Trade receivable. So for you to be successful with journals, you need to understand your double entry principle. Says so. What's the total? We are picking the total 350,000. So we can just link it so you know when you are checking through your record, you'll be able to know, okay, this is what I did. So we have a narration B entries to recognize trade receivable for 2024. So the next journal, like I said, we need to do the two together. The next journal is trade payable, which is people you purchase from your vendors that you are owing. So the two accounts involved here are trade payables and purchases. So trade purchases will be debited, while trade payable, who are your creditors now, will be credited. So we are going to debit purchases. So we have purchase accounts and trade payables. So our purchase account will be debited 600,000, the total sum. So we'll just change this to payables. So the next thing is to incorporate both to in our financial statement. So it to start with our extended TB. So we have trade receivables. Like I said, is a current asset. So it's going to be under current assets. Trade receivables and sales. So trade receivable is to be debited, right? While sales will be credited. So we'll go to sales revenue. Under journal, we'll credit sales. Then the next item is purchases and trade payable. So trade payable is under current liability. So we'll put it under current liability. So trade payable is to be credited and purchases is to be debited. So the next thing we want to check, does our total agree, and if it doesn't, where is the problem coming from? So on our extended TB, it's not our extended TB is showing a difference. That means there's something that is not adding up. So we need to check. Our trade receivable is not appearing on our extended TB, so we'll drag down so it will appear there. Then I will check our trade payable. Our trade payable is appearing on both sides of our extended TB and is only supposed to appear on the credit side. So I'm going to delete the one on the debit side. So the next thing I want to check, sales will be appearing where and the other. So as you can see, the extended TB has agreed. So the next thing you want to do is your statement, various statements. Check if the items that are supposed to appear is appearing there. So I think the problem is on our statement of financial position. Trade payable receivable is not showing here, and our trade payable is also not appearing. So I'm going to drag it down. So with this, our financials should agree. So the next thing I want to do is to take it to my notes to the account. under current level, the current asset. So I should have trade payable, trade receivable, trade receivables. And this is too close. So I'm bringing it from my extended TB, 350,000. So I think we are short of time already. Does anyone have any question so
Good
far?
evening.
Good evening, Tolu.
Thank you so much for your time. Please, are we going to have access to
Please,
this?
I can hardly hear you. Can you speak out?
Okay, can you hear me now?
Yes, yes.
Okay, please, are we going to have access to this on YouTube? I missed some parts so that I can
Okay.
we can be able to go back and understand those aspects that we didn't get.
Yes, yes. It will be on YouTube.
All right, thank you very much.
Yeah, you're welcome. All right. So we would send the video on our YouTube. We'll post the video on our YouTube channel. Thank you so much for your time and thank you for joining. I believe you got value from this. Yeah, so thank you. So this will bring us to the end of tonight's training. Do have a do have a lovely night rest. Bye for now.
Hi, so much.
Thank you.
Bye.
Thank you very much, ma'am, for the opportunity. Thank you for the lesson.
You're welcome. You're welcome.